This webinar is being hosted by CCCD as part of an ongoing educational series called Promoting Shared Wisdom Through Cooperative Connections, which is aimed at supporting the most pressing needs of cooperatives and support organizations. We've been hosting these webinars since May and have a few more ahead, so please keep an eye out for what's to come. For those not familiar with CCCD, we are a statewide nonprofit based in Davis, California. We support all sectors of co-ops across the state with startup, management, and other technical assistance. And finally, we also educate the public and specific groups through our informational literature, tabling events, and conferences. Now I would like to introduce you to Mavery, who will be leading our discussion today. Mavery is a certified public accountant with deep connections to the Westside community of Charleston, West Virginia. He's an independent accountant, runs a financial literacy bootcamp for local youth, co-founded Resolve Financial Services Co-op, and is a member of the C-Coms Network. Through the Financial Literacy Bootcamp, he works with youth in West Virginia to understand the psychology of money and the basics of finances to plant the seeds of collective community, wealth, and abundance. All right, Mavery, I'm handing it over to you.
Welcome, everybody. Let me go ahead and share my screen, and thank you, Jamie, for that wonderful introduction. All right, again, thank you again. Jamie already gave my introduction, so I'm not going to read all of that stuff. I moonlight as an accountant and also as a adjunct accounting professor, which you guys will all learn here pretty soon. So I want to give you guys a brief overview. We got a lot to get through today. But we're going to kick things off with understanding financial statements. And then we're not actually going to do a breakout session anymore. We're just going to do it as a group, kind of mapping out some financial statement terms. Want to see if you guys can tell where things go on financial statements after I get done teaching you. So. Then we're going to talk about ratio analysis, which is very important once you have financial statements in your hand. Understanding how to use ratio analysis can be very helpful. And then we're going to go through some cash flow planning tips and tricks. And to do that, mostly we're going to demonstrate a cash flow planning tool that I use with QuickBooks. And then we're going to talk about the big thing that everybody wants to talk about with co-ops, right? Patronage or patronage, however you want to say it. And then business entity choice. So with that, let's get started. So before we get too deep into this, show of hands, how many people have ever taken an accounting class? Mark, a thumbs up or clap your hands or something, with the tools. Jamie, is it quite a few people ever taken an accounting class? I can't see.
Looks like it, yeah. We've got a lot of folks.
So how many people paid attention in their accounting class and enjoyed it and loved it?
Fewer hands, I see.
Very few hands, right? Yeah, so accounting is not overall, so it's a very technical and mundane subject, and it can get very confusing. Unless you had one of my accounting classes where we might end up playing Monopoly of some sort and putting together financial statements and analyzing financial transactions that way. But so we're gonna get into some of the basic concepts you need to understand with regard to financial statements. So when you hear financial statements, they're typically talking about your P&L or your income statement, or profit and loss statement, your balance sheet, and then your P&L. That's obviously how much you have coming in, and and where you're spending it at, and then obviously what's left over. And then your balance sheet is, it shows your financial position or how much cash you have on hand, other assets that you have, how much you owe to others or liabilities, and what owners have invested in the business or your equity. So uh, that's the basics of accounting. So accounting helps businesses to make strategic financial decisions, as well as comply with the law in terms of being able to, file tax reports and other types of reporting. Um, so a simple form of accounting is when you might budget your spending wisely to ensure that your expenses are less than your income, right? Everybody does that on a regular basis, right? I thought so. So um, this little graphic here, in the accounting, in accounting and in business, you're going to engage in a number of transactions. These can be a few transactions a day, or hundreds of transactions, or even thousands, depending on the size of your business. So all accounting is putting that activity to a filter to generate financial statements. So that's your balance sheet, profit and loss, statement of cash flows, things like that. Um, and these are then used to prepare, again, your tax return. So it's boiling everything down into a format that is much easier to read and to understand, um, than like a box of receipts or other business documents, which is what I get sometimes. Um, So, I've seen it time after time, folks operating businesses, they come with boxes of receipts and they have no idea how their business is doing because they don't have an accounting process in place. So, um, that's something, you need to be thinking about very early when you're forming your business, and all throughout your business. So one of the best ways to manage the accounting process is through some type of software. I use QuickBooks, but there are many other ones. So you put your business transactions through that filter, and you're able to create financial statements. So your balance sheet is going to tell you, is your business healthy? Your profit and loss statement is going to tell you, did I make money this period? And then your tax return, that's going to help you again to be in compliance. So let's dig a little deeper into the income statement. So, what's an income statement? It The income statement is going to show your activity for a period of time. Over a period of time from the beginning of the month to the end of the month, or from the beginning of the year to the end of the year. So it's over a period of time. And that's an important distinction when you compare with the balance sheet, which is at a point in time. So revenues are the money that the company receives during that specific period, and then any gains. So like an increase in value from assets or property, uh, like for example, from the sale of a van. But when analyzing financial statements, you have to be careful um, not to mistake things like gains from the sale of a van with your business operations. So you want to make sure that your financial statements clearly identify what is normally part of your operations and what things are outside of normal business operations, like selling a van. And then you have expenses, so the economic costs that a business incurs in order to earn revenue. So your natural categories are things like wages, rent, utilities, interest paid, things like that. And then losses, the portion of that say, for example, the portion that an insurance company reserves or sets aside for unpaid losses and costs of investigations and adjustments for losses or settlements or things like that. Again, you want to be able to track that information, but make sure that you're not looking at that and including it as part of the business's normal operations, the way that it normally makes money, which is what the income statement wants to track. And then, so here's an example of an income statement and how it does that. Uh, so at the top, you're going to have your sales revenue, and then your cost of goods sold, um, and then your gross profit, and then operating expenses, like we just mentioned. Um, and then you're going to see here that there's a distinction: operating income, and then there's that other income down, kind of separated from things that are not part of your normal operations. Um, so there's an example of a simple income statement. Then you have your balance sheet. Um, so the balance sheet is basically the accounting equation. Accounting or assets equals liabilities plus owner's equity, and that's very important when you're reading the balance sheet. You need to make sure that your assets and your liabilities and equity are in balance. Uh, so, um, so your balance sheet is going to present the financial position of the company, and is organize a list of assets, liabilities, and shareholders' equity at a point in time. So at the end, so say at like December 31st or July 31st, if you're reporting at the end of a month, um, your balance sheet is going to report at a specific period in time. So and it should be formatted such that your current liabilities are presented first. So that's things like cash and things that will be converted into cash within 1 year or the operating cycle. So like accounts receivable, um, things like that. And then current liabilities are things that, like accounts payable liabilities that will be satisfied within 1 year or the operating cycle, whichever is longer. So current liabilities would be things like accounts payable, things you expect to pay in a short period of time. And then you have non-current assets. Again, that would be up in the asset section, but it will be separately identified so that you, as to include long-term assets like property, plant, and equipment, longer-term receivables or long-term investments, and then you have after current liabilities, you would have long-term liabilities um, like notes payable, things that you expect to pay over a more extended period of time. And then your shareholders equity, or your equity section, which captures amounts invested by owners and any accumulated earnings or net income uh, from period to period. So um, here's an example of a balance sheet. You can see things like cash, accounts receivable, supplies, inventory. All of the things that are most liquid are at the top, and then it goes from most liquid to least liquid. Um, for example, you expect to collect an accounts receivable most likely before you sell some more inventory. So that's why it's listed that way. And then property, plant, and equipment, things that help you generate revenues. Um, Current liabilities, accounts payable, salaries payable. Again, you expect to pay that stuff within the operating cycle. And then like a deferred revenue would be something that's also in the current liability section. And again, notes payable. And then shareholder equity. So a lot of co-ops, they might issue shares of stock and things like that. So that's where you would see that number reflected, is at the bottom portion of your balance sheet. And then retained earnings, that would represent the net income. If you notice from the sample income statement, if I can go back a little bit, that net income number is there, um, and it's reduced by some dividends that were actually paid in this example for the year. So that's why the retained earnings, instead of it being 2,917, $1,000 in dividends were actually paid, and we'll talk about what that looks like a little bit later in the presentation. Um, so there's your balance sheet. Another very important statement is the statement of cash flows. So this provides information about the purpose of the statement of cash flow is to report events that cause cash to change during the period. So the statement classifies transactions affecting cash into one of three categories. So operating activities, or inflows and outflows of cash related to transactions entering into the determination of net income. So your revenues and expenses. And then you have investing activities. So this involves the acquisition and sale of long-term assets used in the business, and non-operating investment activities. So if you were to sell, a big piece of equipment or something, um, and then financing activities. So that involves cash inflows and outflows from transactions with creditors or owners in the business. So those are the three core sections of the statement of cash flows. And here's an example of what one of these statements of cash flows might look like. And again, if you're using the proper accounting software, you should be able to produce these financial statements pretty readily. So again, cash inflows, like items from customers, things from rent, cash outflows, rent, supplies, suppliers, or merchandise, or outflows to employees. And then investing activities, you might say purchase some office equipment, and that might reduce your cash, but you wouldn't see that office equipment on your income statement. So that's why it's important to have a statement of cash flow, so that you can see the entity's cash position. Um, because again, that $12,000 wouldn't show up on the income statement. And then your cash flows from financing activities. So that would be things like issuing shares, like a membership drive, or things like that in terms of co-ops. Um, or you might get an increase because you took out a note payable, or a lot of people recently have taken out PPP loans. So you would see that here. And then you would see down at the bottom, you would see your net increase in cash, or if that were negative, a net decrease in cash. So your statement of cash flows helps you to identify your company's cash position. Um, And then the final statement is the statement of shareholders' equity. Um, and so this is also a change statement, and the purpose of this is to disclose sources of the changes in various permanent shareholders' equity accounts that occurred during the period from investments by the owners or distributions to the owners or net income from operating and any other items that might impact shareholders equity. So it's a pretty simple statement, and so you would start off with the equity at the beginning of the period. Excuse me. You would show any increases or investments by owners, and then you would add to that any net income or subtract any net loss, and then you would subtract also from retained earnings any dividends that were declared and paid. So that is your basic set of financial statements. So now I want to see how good of a teacher that I may have been, and see if we can, as a group, identify the items that would go on an income statement as opposed to a balance sheet. So I'm going to share a different uh, screen here. So where might this go? Office equipment, income statement, or balance sheet? Are we getting any responses? I can't see the chat.
People are saying balance sheet.
Okay. What about member capital?
Folks are saying balance sheet again.
Okay. What about supplies?
We're getting a mixture of responses, income statement and balance sheet.
It is balance sheet. One thing about accounting is if you don't see expense in front of it, it's probably a supplies account, like a supplies inventory account. Um, so that was a little bit of a tricky one. What about dividends? Income statement or balance sheet?
A mixture of responses again.
Well, it's not. It's definitely not going to show up on the income statement. It flows. It flows through equity, um, and it's going to go to the balance sheet. Although I'm interested. Are there any other accountants in the room? I've never reported. Um, I've never reported payment of dividends on a on an income statement. Has anybody else ever done that?
So that we have two regular CPAs on the call.
And what do they say?
Sarah says yes.
So it would go on the income statement.
Never mind. She's just saying. Never mind. Sarah's just saying that they're on the call, but not one of them. I'm getting no. People are saying no.
No, I think balance sheet. Sales revenue. That's an easy one. What about cash? Balance sheet.
Balance sheet. Well, yeah.
Salaries expense. What about accumulated depreciation?
People are saying balance sheet.
Balance sheet. These people are smart. They have taken an accounting class before. Depreciation expense. Accounts payable. Salaries payable.
I'm getting a mixture of responses.
Salaries payable. If it's payable, that means you owe it. It's an expense. I mean, it's a current liability. Interest expense.
Income statement. You're saying income statement.
What about prepaid rent? Say if you pay some rent in advance to a landlord.
They're saying balance sheet.
Yes, that is a balance sheet. If you prepay it, it's an asset, and then you would recognize it over time with accrual accounting. Inventory, balance sheet, cost of goods sold,
Folks are saying income statement.
income statement, accounts receivable, balance sheet. All right.
Oh, maybe Sarah has a question. She asked why are supplies on both?
Okay, that's a good question. So, uh, so, so, so this is really should say supplies inventory, right? Um, and depending on how you do your accounting, a lot of people just expense supplies right off, and so they'll never recognize a supplies inventory account. But in some businesses where they might where they might have a large number of supplies, um, they might buy a bunch of supplies in bulk, and then at the end of a period, they'll count their inventory at the end of the year, and then that's the only way they kind of know how much of their supplies they actually use and how much they need to expense. So the journal entry on that would be to debit the supplies expense and then credit or reduce the supplies inventory account. Does that make sense?
So I'm gonna butcher your name. Pedota. So basically, anything with expense or revenue in its title goes into the income statement, and everything else goes into balance sheet.
Yes, pretty much. Everything is going. Everything else is going to go onto your balance sheet. And also too, as you're setting up your business and you're setting up your accounting system, you want to make sure that you've set up your chart of accounts in your accounting system to make sure that it reflects the things that the ways that you receive money, and the ways that you spend money in your chart of accounts, and also in terms of your balance sheet as well. Um, a program like QuickBooks will have this stuff already set up for you, but they often take some tweaking, and you might need to talk to an accountant to see if your stuff is set up correctly. But I just wanted to do this exercise just to get people kind of comfortable with the statements that they'll be holding in their hands as business owners and as co-op members. Um, because income statements and balance sheets, you're gonna have to get acquainted with them. You're gonna have to know them and understand them. So um, let me see if I can get back.
So maybe we have a few more questions. Do we want to do the Q&A right now, or?
Yeah, let's do the Q&A right now.
Yeah, so Bonnie was asking if there was a threshold for kind of office equipment when you decide to, expense it on the income statement versus capitalizing it in the balance sheet.
I mean that's going to depend on like company policy. and sometimes depending on how you're funded, I know with some grants you can only you have to capitalize stuff after a certain threshold. It might be like $1,000 or something like that, but really that it just depends on company policy and the purpose of the asset that you're buying. So if you're buying like office equipment, and it's meant to last for more than one accounting period, you might need to include that as a balance sheet asset.
Asia asked if you could explain capitalizing on the equipment. I guess what does capitalization mean?
So capitalizing equipment means that you're not expensing the whole amount of that equipment at the at the time that you purchase it. It means that you're setting that setting that purchase up as an asset, and it'll show up on your balance sheet. And over time, you will depreciate or recognize a portion of that asset being used up between accounting periods. Does
Um,
that is that a easy? Was that a good way to explain capitalization? Or I
Asia,
always find it hard to communicate accounting terms because like I know it like the way I know it, and it's hard to break this stuff down into English because it ain't English. So
uh,
um,
yeah. So Asia says yes, thank you. And then just kind of going back up. Francis had asked, what is the difference between salaries payable and salaries expense?
good question. So salaries payable is just reflecting that you owe your employees or your staff some money that you haven't paid yet, and so this is frequently going to happen at the end of a year, where you might have, and then you have to, um, like a normal business person probably um, won't normally recognize this. It'll come up like in an audit or something. But let's say you have a payroll period that falls at the end of the year, and a portion of that pay period fell actually in December, but you actually didn't pay the employees until sometime in January. Well, for accounting purposes, expenses have to match the period that they happen. So you have to show a salaries expense for the portion that represented December on your income statement for that end of that period, and then show a payable on your balance sheet to show that the entity has not actually paid that to the employee yet, but the expense is properly recognized. Does that make sense?
All right, maybe we still have a few more questions, but I think just for the
We
interest of
gotta go.
time,
We probably gotta go. um,
we'll
all
have
right.
we'll have a few more Q&A sessions in between all of these sections. So just hold on to your questions, and we'll try to get to all of them.
Okay. And if we don't get through everything, we did include the slideshow, um, and people can email us. All right. So let's go back to screen sharing again. Um, so the next logical part. Wait, what screen are y'all? Are y'all seeing ratio analysis?
Yes.
Okay, sorry about that. Um, so after getting these beautiful financial statements, a lot of times we fail to like actually do anything with them. Partly because half the time we don't understand the statements at all. But once we get comfortable with them, especially as co-op members, we should be doing ratio. We should understand how to do ratio analysis um, to be able to compare our entity to others, or to make other insights based on our own numbers, right? So um, So what is ratio analysis? It's a quantitative method of gaining insight into a company's liquidity, operational efficiency, and profitability by studying its. Hold on, I think my kids are talking. Okay, I just wanted to make sure it wasn't a fight. So, operational efficiency and profitability by studying its financial statements, such as the balance sheet and the income statement. The 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 two things that you're going to see a whole lot. Um, so, uh, so some of these ratios that you're gonna want to look at are liquidity ratios. So liquidity ratios measure a company's ability to pay off its short-term debt um, as they come due, using the company's current or quick assets. Um, and I'll explain what quick assets are here in a second. Liquidity ratios include the current ratio and the quick ratio. So quickly, uh, who can what insight can you get if you have a current ratio that is below one, or even a quick ratio that's below one? What is that telling you? What do you think? You see any responses, Jamie?
Sarah is saying it's not good. You need more money. Kate.
Dang right. Yes, that does tell you that you definitely need more money. So the current ratio measures your ability to pay off your current liabilities payable within 1 year with your current assets such as cash, accounts receivable, and inventories. So the higher the ratio, the better the company's liquidity position. But again, the current ratio is a little bit loaded, right? It assumes that just because you have accounts receivable that people are going to pay, and it assumes that just because you have inventories, you're going to sell them. That's that may or may not happen, but we hope that it happens, right? And it's a good indication. But um, uh, a less diluted um, ratio is the quick ratio, where you would take your current assets, your most liquid assets. So you would take your current assets and you would subtract out your inventory and things like prepaid expenses. Um, and then you would have a ratio that would indicate where your company is in terms of liquidity, with its most liquid assets. So, and again, if that's below one, then you need more money. You might need to be looking into some other ways to get more money into your operation. So, good response. Solvency ratios. Solvency ratios are also called financial leverage ratios, and they compare a company's debt levels with its assets, equity, and earnings. Um, to evaluate the likelihood of a company staying afloat over a long haul or by paying off its long-term debt, um, uh, as well as the interest on its debt. So examples of solvency ratio are the debt to equity ratio, um, and uh, and total and the debt ratio. Um, in which is the total debt over total assets. So the higher your debt ratio, the more leveraged the company is. So it's implying greater like financial risk, and at the same time, leverage is an important tool that companies use to grow. And many businesses find sustainable uses for debt. And debt ratios, they're going to vary across industries. With capital intensive businesses like utilities or pipelines, having higher debt ratios because you just need more capital equipment for those types of industries. And most likely you're going to finance those things because they're large ticket items. And then other industries like the technology sector or for accounting services, things like that don't require as much capital, so you might not have as much debt in industries like that, or it might not be, uh, it might not be as if you having high debt ratios in those industries, you want to make sure that you have a really specific purpose for it, and that debt is actually helping you to grow your business and eventually win you off of it. Um, so, uh, so if a company, for example, had $100 million in total debt, and or had $100 million and the total debt was 30 million, then the debt ratio would be like 30%. And that could be good or bad. It just depends on the industry and if it's normal, if you're comparing it to certain benchmarks. So um, so you shouldn't use any of these ratios in isolation. You should be comparing them uh, either to prior periods or prior years or other entities, just to see if they are reasonable. Uh, then you have profitability ratios. These ratios convey how well a company can generate profits from its operations. So, like, profit margin, return on assets, return on equity, return on capital employed, and gross margin ratios are examples of profitability ratios. So so a normal return on equity, net income over average shareholders equity, say for example in the utility sector, could be 10% or less. A technology or retail firm with a smaller balance sheet accounts relative to the net income may have normal return on equity levels of 18% or more. A good rule of thumb is to target a return on equity that is equal to or just above the average for the peer group. Um, so, for example, let's assume a company had maintained a steady return on equity of 18% over the last few years, compared to the average of its peers, which was 15%. So somebody who's investing in this operation, or members of the co-op, could look at that and conclude that their company's management is above average because it's experiencing higher than normal return on equity numbers as compared to others doing similar things. Um, so then you also have gross margin, which is your net sales minus your COGS, or cost of goods sold. Um, so this is a company's net sales revenue, again minus its cost of goods sold, and it's the sales revenue that a company retains after incurring the direct costs associated with producing the goods that it sells. So um, uh, this is a very important number because it's everything that it's what you're selling your product or service for, and then all of minus all of the direct costs associated with producing that product or service. Um, so the higher the gross margin is, the more capital a company retains on each dollar of sales, when it can be used to pay, and it can be used to pay other costs, to satisfy debt obligations or other operating costs. And so the net sales figure is simply your gross revenue less any returns or allowances you may have, or discounts you may have given to customers. So if a company had a gross margin ratio of 35%, that would mean that it retains 35 cents for every dollar in revenue it generated. Um, then you have efficiency ratios. Um, so these evaluate how efficiently a company uses its assets and liabilities to generate sales and maximize profit. So a key efficiency ratio is inventory turnover for entities that deal with large volumes of inventory. So that's you calculate that cost of goods sold over average inventory. So the higher the inventory turnover, the better. And since a high inventory turnover typically means a company is selling goods quickly, and there is considerable demand for that product. So, and then a low inventory turnover ratio, on the other hand, would indicate that you have weak sales or that you have declining demand for a company's product. So, you if you sell different types of inventory, you might want to calculate this ratio for your different mixes of inventory to see maybe if there's more or less demand for one of your items that are included in your inventory. Um, and then you have coverage ratios. Um, and there are tons of other. There's a bunch of financial uh, statement ratios you can use. I'm just pulling out some of the most common and most powerful ones, but um, coverage ratios measure a company's ability to make interest payments and other obligations associated with its debts. So, an example includes the times interest earned ratio, or that's your earnings before interest and taxes. Um, so that would be your income, you know, not considering any interest or taxes to be paid, and you would divide that by your total interest payable on bonds or other debt. So um, so the result is a number that shows how many times a company could cover its interest charges with its pre-tax money or its pre-tax earnings. So obviously, no company needs to cover its debt payment several times over in order to survive. However, the times interest earned ratio is an indication of a company's relative freedom from the constraints of debt, generating enough cash flow to continue to invest in the business is better than merely having enough money to keep you away from bankruptcy. So those are some of the key ratios that you're going to use. So let's go over a couple of key takeaways for ratio analysis. So ratio analysis, again, it compares line item data from a company's financial statements to reveal insights regarding profitability, liquidity, operational efficiency, and solvency. Um, the whole reason we started with financial statements to begin with. Ratio analysis can mark how a company is performing over time while comparing a company to another within the same industry or sector. Um, Benchmarks are good. And also, while ratios offer useful insights into a company, they should be paired with other metrics to obtain a broader picture of a company's financial health. So again, don't use ratio analysis in isolation. Look at different industries, look at different companies. Look at different periods from the same company from year to year, month to month, things like that. Um, so, uh, Jamie, how are we doing on time? Do we want to stop for some Q&A on that, or just
So yeah, so we're pretty behind, but I mean, there's a lot of questions and a lot of good content
okay?
going on. So just kind of throwing out there, we might kind of be going over time, but we'll kind of, we'll just monitor. But if that were to happen, maybe, um, how do you want to kind of go forward with that?
I don't mind to stay over if people want to stay. Let's ask people. I mean, people who came to the workshop. Do you want to address those questions now, or do you want to move forward to cash flow planning?
Um, well, yeah, and if you guys could just, put in the chat what you prefer, we'll kind of make decision. There will be a recording, so if you can't stay on past 12:30 Pacific time, then the recording will be available. So people are saying just keep going forward. So
Okay. Well, let's just keep going forward.
okay,
Um,
and then we do have
so
questions. But should we wait till the end? There's one specifically about kind of the ratios.
okay, let's save it to the end, and we'll try to address it. Um, so cash flow planning. Um, this is a very important activity that we need to do as business owners, as cooperatives, as any type of business. Um, and before we can adapt to changing conditions in our business, we need a clear picture of the current state of things. So a cash flow forecast helps us to determine like how long we can maintain business operations given typical patterns of bringing in and spending money. um, and we can use a cash flow planning tool like the one I'm going to demonstrate with you all here in a moment to evaluate like what if scenarios based on potential adjustments to revenues and expenses. So this tool sets a goal to create a 3-month plan to help our businesses stay cash positive. That's a good increment to kind of look at things. It's not too far out, but it's not so short of a period that you can't kind of identify some sort of pattern. Um, so but before starting this process of using this cash flow planning tool that I'm going to show you all, um, you need to reconcile your books how in whatever form that you have them in, whether you're doing it by hand in an Excel workbook or something. You need to reconcile your books, and that means someone in-house or outsourced with your business is comparing bank statements to your accounting system. And this is going to help you to identify open invoices or amounts owed to your business and any unpaid bills that need to be considered. And also, following reconciliation, your profit and loss reports and any other reports you need to run out of your accounting system or information you need to know will be the most useful and the most up to date. Um, Now, forecasting, while we're forecasting, we'll be able to anticipate different sources of cash, and identify expected short-term cash outflows. Um, so I'm gonna go to cash flow planning to here. Let me share my other screen. All right. So we've included this cash flow planning tool for you all, and you should have access to it at some point following the workshop. But how you would use it is once you were to get access to it, you would have to click File and then make a copy, and then you'd be able to edit it. Um, but but simply what you do with this tool, step one is you might want to put your business name in there, but um, you know, pick a start date for the planner. I set this one to start for today, September 9th, and then the worksheet is going to project out over 12, 13 weeks or so. Um, and then what you would do again after you've had all your books reconciled. In this example, there are several bank accounts that this entity has, and I've listed some balances in there for each of those bank accounts, and even undeposited funds. So funds that the entity had on hand, but they hadn't deposited it into the bank yet. And so this first part of the worksheet is going to give you your starting cash from this planner date. Um, and then step two, you're going to go to the cash flow planner tab, and then you're going to calculate cash on hand for the business over 12 weeks, and use there's different what if scenarios you can put in there to identify the best options for your business for staying cash positive. Again, this will be unique to your business and what assumptions you have and what you know. But to use this again, after you were to select copy up here and create a new sheet, you would need to click run now for the worksheet to and it'll prompt you like this: authorization required, and then you would just give it tell it click allow so that it can run its calculations. um, and then after you were to finish the cash flow planner tab, then you would get a summary tab. So let's take a look at the cash flow planner tab. So um, and really neatly, it shows for each week, it shows your net cash flow. It shows your starting balance of cash and your ending balance of cash, and all of this is automatically calculated for each week as you input different assumptions about what your cash is looking like in your business. So, for example, here, the week of September 4th, there were several different sources of income that amounted to about $6,600 or $6,600. And the week of September, ending September 11th, I had 2,400 and revenues expected, and so on. And so that kind of goes all the way, until you've got 12 weeks of information in there. Um, and then you can use these what if scenarios. So you can explore, these options for increasing your cash inflow. And there are some ideas in here to kind of get you started. Um, uh, I don't know who has this ability, but I ain't got. I don't know who has personal savings of $20,000. But if you do, that could be something you do to, or maybe you do some sort of membership drive or something uh, to get some personal savings or something invested into the business. Maybe you borrow from family, and in this scenario, we're assuming that we had borrowed from family the week of September 4th, and then we borrowed from family another $1,000 each week starting October 30th through November 27th, for a total of $10,000 borrowing from family. So um, and then there's a PPP loan or the payroll protection loans that are out right now, and so there's a what if scenario. What if we had one of those loans, which is a pure what if, because I don't know very many people who are able to access those right now. um and so after you were to after you were to do that, work on that section as far as the, what if on additional income, uh, there's a money out section here where you can enter the amount of unpaid bills with their appropriate due date, in each of the columns. Uh, and again, that'll calculate straight across. And then this bottom part here is what I like the most. The what if scenarios on exploring ways to reduce cash outflow, and there's some ideas there, maybe deferring a loan payment. And if you're gonna be reducing any, if you're in your forecast here, you need to put a negative number in here for the spreadsheet to calculate properly to reduce to reduce your overall expense if you're going to deploy one of these what if scenarios. And if you would put a positive number in here, that would indicate that your what if scenario includes the possibility of having increased expenses of some sort. Um, and so once you fill this worksheet out for each week, you'll have total money out over here at the right. You have total money in, total money out over here at the right. And then you get this cool little summary, this little summary tab, and it's in graph form, so you can see kind of what month where things are getting tight at. um, Here in around September, something big happened here between September 25th and October 2nd. I think it was this $50,000 $50,000 on mortgage. So maybe in this scenario, somebody's making a down payment on a building or something. But that's pretty much how you use this tool. And then these there's a graph down here at the bottom that shows the total money in and money out for your business in nice, neat little bars. And you can see which weeks your expenses or your revenues or what they're looking like over that 12-week period. So that's pretty much it for that. And so you want to just be looking for ways to to maybe increase your revenues, or there might be different programs you might put in place or something. If you notice that you're gonna have a cash flow shortage, maybe you change the way you accept money. Maybe you're a cash only business, and changing to accepting credit card sales might help you to increase sales somehow. So you just want to talk with your team and everybody involved with your business to try and figure out if you can forecast and make some projections on how to keep your business cash positive. So that is going to do it for that part. So let me go back to I think that was my son said he's going to go back. One moment, got to put my notes back up here. Okay, so that's pretty much it for cash flow planning. And again, we included that tool for everybody to use. And once you copy that, you can make any edits you want to it, and make it unique to you. Moving on to patronage. This is so really everything we've been talking about with financial statements and everything. When it comes down to co-ops, um, patronage is pretty much what we're all here for, right? The ability to have some say in what to do with that net profit. So this is a pretty cool graph that I picked up from Cooperation Works, and it's pretty much the most straightforward way you can explain all of this stuff. um, so um, so at the end of an accounting period, usually a fiscal year, the cooperative's accountant is going to determine whether there's any surplus or money left over after expenses. If there is any surplus, the board is going to decide what to do with it. So the options are to one, keep the money in reserve. So that's that blue all the way to the right at the top, unallocated. Uh, so one is to keep all the money in reserve to cover unforeseen expenses or invest back into the co-op. Two is to distribute the surplus to members. Or three is so that's your the gray box, allocated patronage, dividends or refund, or dividends to preferred shareholders, which could be members or non-members. But three, you would do some combination of one and two. Retain some and distribute some to members and non-members. But unlike a regular corporation, the surplus is distributed not based on ownership interests, but on patronage. So, for example, in a producer cooperative, if one member delivered 30 pounds of broccoli to be marketed through the cooperative, and another member delivered 10 pounds of broccoli during the same period, the first member would receive 3 times as much of the surplus as the second member. Um, Now, if some of the patronage is sourced from non-members, the cooperative will have to calculate what percentage of its total revenue is attributable to member patronage, and only surplus attributable to member patronage may be distributed to members if the cooperative wants to get the tax benefit related to patronage distributions, which I'm obviously going to have to explain. So the cooperative can choose to pay the entire patronage dividend in cash, or it can simply allocate all or a portion of the dividend to the members' capital accounts using a written notice of allocation, which is defined in subchapter T of the Internal Revenue Code. Um, so the use of written notices of allocation allow the co-op to retain more cash within the co-op, and the co-op sets a policy as to when members may withdraw these funds as cash from their capital accounts. And one common practice is to redeem this on a rolling basis to prevent long-term members from accumulating um, very large capital accounts. Some co-ops pay interest on the balance in the capital accounts to prevent members from becoming frustrated by having capital accounts tied up in the cooperative, but not receiving any financial return. So, um, so to explain a little bit about this green area that you see here with the minimum of 20% allocation required in cash and 80% qualified allocation can be retained. Um, so what that's saying is if there is an allocation based on patronage, as long as 20% of that is paid in cash, then the co-op can can deduct a portion of that, um, you know, uh, from the co-ops, from the entities, uh, from the entities' taxable income. So earnings in a regular corporation are double taxed, and the corporation pays income tax on the net earnings, and then the shareholders pay income tax when they receive dividends on those earnings. Now, in contrast, under subchapter T of the Internal Revenue Code, a cooperative can avoid some of the traditional corporate double tax, assuming the cooperative meets all the requirements set forth in the code. Patronage dividends are generally tax deductible for the cooperative is if at least, again, 20% of each patronage dividend is paid out in cash. And of course, the members are going to have to pay income tax on the total patronage dividend that they receive, regardless of whether it's paid in cash or as an allocation to the members' capital account. Um, so, so the so again, the green member, so the member or patron pays any required income tax, to any allocated patronage give distributed to them, and then a co-op is going to pay income tax upon future that dark blue one if um, if it was a non-qualified written notice, then the co-op is going to pay income tax upon future distribution to member. The member or the patron is going to pay any of the required tax, and the co-op receives a tax credit. Um, so, uh, so patronage dividends, they must have wording in the bylaws or operating agreement allowing for patronage dividends. Um, there must be an allocation formula based on the business done with the co-op, and it needs to reflect how profits are earned. So worker co-ops usually use hours for the calculation, um, because worker co-ops are normally selling some type of service, um, and they may use different weights, but you have to research it, and it has to be documented in advance. And other co-ops might use different measures, and you can't use the amount that was of the initial investment. It has to be based on like the business done, or the way the co-op earns revenues. Um, to look at an example, let's say you had taxable income before patronage dividends for 2020 of 20,000, and based on, so that's going to be based on federal taxable income, which is income before taxes. Taxes, or it takes into account tax depreciation methods, and other tax adjustments, including meals add back. So like meals and entertainment are, not deductible. So you need to, this number would include that amount being added back in. And then this is taxable income before any loss carryovers from prior years. Um, so again, in this example, let's assume that a member A worked 2,000 hours, member B worked 1,000 hours, and non-members worked 1,000 hours, giving us a total of hours worked of 4,000. Um, so to allocate the $20,000 in the profits earned, so member A was 2,000 hours. So you take that divided by the total hours, multiplied by the profit, and member A would be allocated 10,000. Member B worked 1,000. Divide that by the total hours worked, 4,000, multiplied by 20,000. The profit, and that member B is allocated 5,000, and then non-members worked 1,000 hours, and they would also be allocated $5,000. So, so the maximum patronage dividend, member A would be 10,000, member B would be 5,000, and so the total patronage dividend would be 15,000. Non-members was 5,000, and that would be not be allocated, and the co-op is going to pay tax on the 5,000 as opposed to the 20,000, and it could be allocated, but it's not often done. So uh, so continuing this example some more. So patronage dividends allocated to member A, 10,000. So as long as the co-op allocated 2,000 of that, or 20% of that as cash, then they would be able to retain the other 8,000, and it would be allocated to that member's equity account. And then member B, 5,000. So $1,000 of that, it's 20% of 4,000 would need to be contributed, would be distributed in cash. And then 80% or 4,000 could be or would be allocated to that member's capital account. And then, so what's the result? Patronage dividends allocated in cash, 3,000, and patronage dividends allocated as equity is 12,000. And then taxable income to the co-op is 5,000. So, assuming these tax rates, if the federal taxation was 21%, then they would owe $1,050 federal tax. If the state tax was 9%, they would owe 450, and then the total tax paid for the co-op would be 1,500 in this example. So so you need to issue, so the co-op again would need to issue a notice of allocation of the patronage dividend and pay the cash portion. They would need to mention in their bylaws or other policy on patronage dividends, and then they would specify the cash and the non-cash amounts, and then the total amount would need to be reported on form 1099 PATR for the calendar year the notice was issued, and that needs to be issued to the co-op members. And so here's an example of what this notice of allocation would look like. You know, in accordance with our bylaws, section in the section, your total patronage dividend is $10,000 based on the allocation of the 2019 taxable income of the co-op. Enclosed is a check for $2,000. The additional $8,000 is added to your individual retained patronage dividend account, and the entire $10,000 will be reported to you on Form 1099 PATR and will be taxable on your personal income tax return for 2020. So that's what an example of one of those will look like. So talking about 1099 PATRs, so this again is going to the member. is reporting this different and uncommon. So tax preparers and softwares have problems working with 1099 PATRs. Like I don't think TurboTax handles them. If you're trying to self prepare, I don't think TurboTax handles a 1099 PATR. Um, so your income qualifies also would qualify for the 20% qualified business income deduction. So that's IRS code section 199A. Um, and uh, it essentially allows 1099 PATR income to be included as to qualify you for that qualified business income deduction. The important thing here about from a member standpoint, all of that patronage allocation is going to be taxed, even though the co-op itself gets a deduction for for allocating the patronage appropriately. The member is still going to be issued a 1099 PATR for the full amount of their allocation. So this other part of the tax law is more specific to the individual member, and you get to deduct 20% of your qualified business income from your taxable income. Um, so there are some limitations. There it phases out based on income, and also there in certain types of businesses may not qualify for the qualified business income deduction. And if you if you have non-owner employees, that might be a limitation. Um, so the 1099 PATR generally is not subject to self-employment tax, and it can vary by recipient. But for worker co-op members, a patronage dividend is almost always not subject to um, self-employment tax. And there's a detailed discussion of the patronage dividend and self-employment tax issue by attorney Gregory Wilson, and then there's a link to that discussion if you want to know more about that. Yeah, so that does it for that. And really, in terms of business entity choice, to be a co-op or not to be, we've also included a link uh, to all of the state statute co-op laws that you can take a look at. Many of them, you know, many of them, like for example, in West Virginia, you have to be like in the agricultural industry or something like that. Um, and in California, your co-op needs to be for the benefit of set up for the benefit of patrons. You know, so there's just little things like that. But we did include a resource for you all that lists out all of the co-op statutes throughout the U.S. In a nice spreadsheet. And then there's also a document, a link to Wagner CPA's website that shows all of the different entity types and tax regulations and different things like that in a chart form as well, which we included in the resource link.
Um, we have a couple kind of questions from folks in the chat asking about if we can do a follow-up webinar for COP entity choice. We'll have to kind of figure out the next step. So, but we'll let everyone know kind of how that works out. But yeah, sorry. There's just there's so much good information today. I think an hour and a half was just not enough, no matter how much we tried. Um,
Uh,
but but we'll definitely follow up with everyone about that possibility. Um, and again, uh, we do have an evaluation, so please kind of fill that out when you get the chance to do that. And um, if we can kind of go straight to the Q&A, if everyone's good with that. Any questions? Otherwise, we have a list that were sent before.
yeah, if I can address, I do remember getting a couple of questions beforehand. So let me pull up my answers to those. I don't know who asked them, but all right. So somebody asked, how do we pay worker owners that are undocumented? To my knowledge, um, you would essentially need to pay them as independent contractors, um, or in which case they would take care of the taxes as a, as a sole proprietor, so to speak, or if they're if you're formed as an LLC, they can receive distributions in a K1, and they can handle their taxes that way, and they wouldn't be subject to employment laws as a owner. Um, then there was another question: what are the best methods to record labor patronage, and what does that journal entry look like? Um, so for labor, I would suggest allocating it based on hours worked, and the journal entry would be a debit to a wage or salaries expense, and then you would credit the member equity account. Um, and then how do dividends work for co-ops? We just went over all of that stuff. Do we need to do that again? Um, Essentially, the biggest takeaway there is if your co-op is big enough to where it's going to be paying a significant amount of patronage, then you may want to be formed as a co-op under subchapter T, so that you can have a pretty significant deduction from taxable income, because ultimately that helps uh, that helps all the members of that co-op, because everybody owns it. So that is one good tax benefit, is being able to deduct patronage dividends to some extent. Um, Otherwise, if patronage is not like a huge consideration, or very significant, you may want to just stick with like an LLC type structure and do distributions that way. Which states are most pro cooperative to incorporate? Now, I mean, I wouldn't quote me on this, but I'm assuming Minnesota and Wisconsin, uh, because they have some of the strongest like co-op infrastructure in the country. There's a lot of co-ops in those states, and they have uh, lots of people, and like people fighting for co-op laws, and to be recognized and stuff. So I would say places like Minnesota and Wisconsin, or places where there's just a lot of co-ops in general already. Um, and is there a such thing as a liability insurance company, co-ops, and health insurance or healthcare provider co-ops? Um, that sounds like a shared services co-op or a worker co-op. So like a worker co-op model. So I mean, anything can be a co-op. It's really in your bylaws, one member, one vote, and and sharing profits based on use of the co-op. Um, and then there's an example for for healthcare. There's an example in the resource links that we sent that has a case study for cooperative home care associates as a case study for that. So if you want to know more about co-ops and healthcare, you can check out that case study or check out that links to cooperative home care associates. Were there any other questions?
Yeah, one question from earlier was, what are the most common systems used for accounting for co-ops? Is it QuickBooks Online, desktop, any open source accounting systems, Excel, NetSuite?
Um, so depending on your size, I mean, most businesses, frankly, just use QuickBooks. You know, most businesses use QuickBooks. It's it's fairly easy to get a hold of an accountant using QuickBooks. I'm biased towards QuickBooks because I use QuickBooks and I also sort of work for Intuit from time to time. So obviously, I'm going to tell people QuickBooks, but if you have somebody on your team who's good with Excel sheets and things like that, especially if you're a startup, a good Excel workbook would do just fine in terms of keeping track of your financial information. But and then QuickBooks is relatively cheap, and I think it's a good place to start in like setting up your accounting system using something like QuickBooks because you can get it for pretty cheap. And so I mean that would be my advice. Um, any other questions?
A question just came in just now is, do you prefer QuickBooks Online or desktop?
I prefer QuickBooks Online because I prefer QuickBooks Online because again, is everything is in the cloud. You can generally work from it no matter where you're at. You can have it on multiple devices. You can have multiple instances of QuickBooks open at the same time. Again, you can connect with accountants fairly easily. Um, uh, so I would suggest QuickBooks Online for folks if they were choosing between desktop and online. And I also know that QuickBooks is discontinuing some of its desktop functionality, specifically in terms of payroll. So QuickBooks Online, I think, is where Intuit is sort of pushing people to go anyway. So you might as well join us. So
Um, and this is kind of, I think it's related to QuickBooks. Are there any plugins or system add-ons to add cooperative specific accounting functionality? I'm guessing like something like apps.
no, no, not yet. We that is definitely something we should be thinking about as cooperators and people who deal with cooperative financials is figuring out some kind of add-on um, for for QuickBooks. Um, I would say though, a really good resource for learning how to kind of adapt um, QuickBooks for your company is QuickBooks Made Easy. Um, they offer like really extensive training and things on QuickBooks and how to modify it to like kind of tweak it up to to fit your operation and what you want to do. Um, so QuickBooks Made Easy. I think the guy's name is Greg Bosson. He's a CPA. He's mostly works with nonprofits, but um, co-ops have a lot of unique features and things about them, and I think you can learn a lot out of that training that you can take and extend from say like a nonprofit to what you're trying to do with a co-op. Um, Uh, yeah, that's how I would answer that question.
Um, so cooperatives are nonprofit entities. How far do the accounting principles apply to the cooperative form of business?
Hmm. Can you ask that question one more time?
Yeah, so cooperatives are nonprofit entities. How far do the accounting principles apply in cooperative form of businesses? The cooperative form of business.
Well, I mean, cooperatives are definitely uh, out to make a profit. um, the way that profit is distributed and shared is unique, but um, I mean, e- even with nonprofits, I mean, largely you still got to follow, core accounting principles, and really the differences or the tricky things come in terms of like your reporting and like for a nonprofit how it has to report specifically on fundraising, general and administrative, and what it's doing with its programs. Uh, so I don't know. That's a pretty hard question. I mean, in general, I think you're safe just sticking with core accounting principles, and that's good for any business, for profit or nonprofit.
I think what they might be referring to is the at least in California, the cooperative corporation statute is, I think, under the nonprofit.
Yeah, it is. It
So
is.
I think that's what they meant. So not that, co-ops are nonprofits, just that in terms of statute, that's where they're at.
So that would go again, like, so if you're using a program like QuickBooks, you can set that up to do that reporting. Because I don't, I'd have to look into the California statute, but I know from a federal perspective, in California, it's probably very close to how I'm guessing right here. So again, I would have to look into this specifically, but from a federal standpoint, nonprofits have to again report, um, very specific, their financials in very, very specific ways with reporting general and administrative expenses, fundraising, and their programs. It has to be set up that way, and you can tweak QuickBooks using the customer and class system to set up reports that will help you to report, at a federal level, and most likely for how you need to report for California as well in terms of a nonprofit.
Um, okay, so we have one question that came through. Could you further explain how having non-worker owners in a worker co-op, how that could impact the ability to qualify for QBI?
Um, I have to look up that regulation specifically so I can get back to them on that one.
Okay. Um,
Sorry.
alright. Um, so, oh, maybe did you want to just kind of give a shout out about the Resolve survey?
Oh yeah. I guess I'll pull it up. Um, so let me get that back. Uh, this in here somewhere. So we are starting a financial services co-op. And currently we go by the name of Resolve. Uh, and currently there are 6 members, and myself and Jamie are one of them. And we're still in the formation stage, so we're not quite launched yet. But who are we? We're accountants with personality. Uh, we're building a full service accounting cooperative, um, that's going to span pretty much nationwide. We got members in right now in California, West Virginia, New Orleans,
Yeah.
Maryland, and Georgia. Oh, in St. Louis. So that's where the six of us are. We're all actually in six different states. But we are dedicated to education, solving problems, and helping people. We're passionate about helping co-op business owners and also nonprofits and individuals succeed through proactive tax and business planning. So our services are going to include tax planning and preparation, QuickBooks consulting, outsourced accounting and CFO, and other business filings. So what we're asking folks to do at this point is um, we have a sort of a needs assessment survey. I'm gonna post it in the chat, and we're just asking people to fill that out and give us some feedback on the types of accounting services that you think you are in the market for. Um, and that's pretty much my spiel. And I just posted the link.
Well, well, there's still a few more questions if but I mean, if you want to just end it.
We can take a couple more.
Couple more? Okay. So while everyone's kind of filling out that survey, so we have one from, I am the admin of a home care cooperative. I'm looking for ideas to cut costs to survive this long COVID storm. Our grant
Mm-hmm.
our grant money is exhausted, and we have used up all of our PPP funds. I think they're just looking for kind of tips to reduce expenses.
Tips to reduce expenses. I mean, you hate to say it, but um, obviously you might need to ask members if there's any way they can cut back on their salaries. Um, that's one area. I mean, obviously, we don't want to do that because it's COVID. But maybe there are some members that are more financially stable than others and who would be willing to make that sacrifice. That's the good thing about a co-op. Nobody's going to just kind of do anything that's going to be detrimental without getting other people's feedback. Um, Another thing you can do is call and reach out to suppliers and vendors and see if there's any way they can extend, favorable credit terms to you while you're in this time. Um, you can unfortunately some businesses, if your business is actually operate, you might want to look at facilities and different things that maybe don't have high traffic right now or something, and maybe you can defer rent or um, stop leasing something if you're renting or something like that if you don't actually need the space. um, but if your business is still operating and you just absolutely can't cut back on anything, you may have to continue working on that other side of the equation, which is finding more income. So I don't know. They're tough times. Um, but I mean, we can continue that conversation offline, um, and uh, and think of some other strategies. But that's all I have, like off the top of my head right now.
Okay. Thanks, Mavery. Um, should must Social Security tax be paid on patronage dividends, or is it treated differently than employee wages?
No, that's uh, patronage is not allocations are not payroll.
What's the difference between COGS and operating expenses?
Okay, so COGS are directly related to the product or service that you're producing. and really services don't necessarily have cogs, but if you're producing a product, those are things that like directly go into producing it. So a real simple example, let's say you're making lemonade, like my daughter makes lemonade. um, cogs would be things like the lemons, the sugar, the water, things that go directly into making that product. Um, Operating expenses are things like um, salaries. Now, some portion of your salaries might be directly related to making the lemonade, right? But in general, there's going to be other salaries that you're paying that are not directly related to that. Rent, um, rent might be something like that. Office supplies, things that are not directly related uh, to your to the product that you're producing are not cost of goods. So does that answer your question?
Well, hopefully it does.
Okay. Okay.
Okay, well, I think we have 1 minute left before it hits one. I think we've um, taken up enough of your time, Mavery, but I really appreciate everyone for joining us during this call. Maybe did you have any remarks?
I just wanted to say thank everybody for tuning in and listening to a very long presentation about really just accounting 101 for the most part. But I just want to leave you all with um, this is understanding your financial statements is the best thing you can do as a business owner, and over time the more you know about it, it's actually going to be your biggest cost savings, and your biggest revenue generator is really knowing your numbers code. And I'll just leave it at that.
Thank you again, Mavery, for your time, and hope to see y'all soon.
Bye.